Welcome back to a new SharmaFX Weekly Outlook. This week, the markets are running on headlines and not data. We are in a US data blackout from the government shutdown. Gold is melting up towards $4,000 an ounce. Bond volatility is collapsing, and global politics from Washington to Gaza to Paris are dictating risk sentiment. So let's break down what's really driving this market and what the big players are doing behind the scenes. The US government has officially rolled into a second week of government shutdown, and that means no labor reports, no CPI, no retail data, nothing. And that's left traders blindfolded on macro direction, forcing the market to rely entirely on sentiment, headlines, and positioning data, especially from private sources. Bond volatility has collapsed to its lowest level since 2021 because there's simply no catalyst for the large moves. But whenever Washington does reach a deal and the data resumes, volatility will explode back in as traders rush to reprice everything from yields to rate cut odds. If you guys have been following me for a very long time and you have seen my technical breakdowns, you must have heard me talk about whenever the market consolidates or any pair consolidates, especially on higher time frames, we can always expect larger moves to be on the other end of that consolidation. And if you think about it, we're pretty much in the same situation, but on the fundamental side now. We're in a US government shutdown, we are in a data blackout, and so in a way, we are sitting in this consolidation. Whenever the government opens up, whenever that data comes back, we are absolutely going to expect that there's going to be a lot of volatility in the market, and we will be able to catch longer swing trade opportunities then as well. So until then, we're sitting tight, we're relying on the private data, and we're relying on the market sentiment to catch these shorter term moves. Meanwhile, gold continues its historic run, breaking new records almost daily and inching towards the psychological $4,000 level, which we're going to break down on the technical side in just a little bit. This move is fueled by safe haven demand, central bank accumulation, and an investor shift towards hard assets as the Fed continues cutting into uncertainty. The Fed will meet again on October 29th, and the market is already pricing another 25 basis point cut. But the real problem here for Powell and everyone else at the Federal Reserve is that if they cut too fast, then they risk a tariff-fueled inflation. If they cut too slow, then they risk a deeper labor market deterioration that's already showing up in private data. In the meantime, the White House has started floating healthcare negotiations with Democrats as leverage to end the shutdown. But we don't have any sort of timeline, we don't have any sort of development on when the government will open up or if they've even agreed on anything. So all of this is simply just injected political noise into the markets that were already struggling for clarity. And as it stands, there's no breakthrough yet. The longer the standoff drags on, the more uncertainty premium gets priced into bonds and the more gold benefits as safe haven. For equities, though, the story remains the same. They're still structurally resilient, but headline sensitive. The NASDAQ, S&P, and Dow are holding up, largely thanks to AI capex and earnings momentum, but institutional desks are now cutting leverage and scaling back risk exposure into mid-month. Now let's zoom out a little bit and take a look at central banks. Globally, central banks are splitting into two camps, those cutting cautiously and those holding firm. I think this map does a great job at just showing that visually, and this article I think is also very important because regardless of whatever central bank or whatever currency that you're trading, this article breaks everything down. Starting off with the Federal Reserve, the Fed is still continuing to ease into the year end, while ECB and Bank of England are both on pause, signaling the end of their easing cycles. The Bank of Japan is the outlier here, though, as you can see in the pink, the only country being in pink, and they're leaning hawkish with a possible October rate hike as inflation sticks near the 3%. Meanwhile, Bank of Canada and Reserve Bank of India are preparing mild cuts, trying to balance weaker growth against imported inflation. And overall, this policy divergence is what's creating and driving this foreign exchange dispersion that we're seeing on the currency end. The euro is struggling under the weight of political risk in France, which we're going to get into in just a little bit. The yen is gaining support from expectations of a BOJ hike. The pound is quietly benefiting from a positive trade optics after UK's Prime Minister, led 100 people business delegation to India following the UK-India Free Trade Agreement. This deal removes tariffs on more than 90% of UK goods, reinforcing UK's global trade stance post-Brexit. And overall, this was a small but meaningful confidence signal for GBP investors. Developments on the geopolitical news that we were discussing last week in the previous weekly outlook. The geopolitics this week also still remain a powerful undercurrent. In the Middle East, Trump's 20-point Gaza peace plan has entered active negotiation in Egypt, with US, Israeli, and Qatari mediators now in Egypt trying to get Hamas to agree to this agreement here. But if the deal sticks, we could see that the risk appetite overall across all global equities will increase. But if the talks break down, then we're going to expect renewed safe haven flows into gold, yen, and US treasuries. Headed over to Europe, France is sliding deeper into political crisis, where the Prime Minister Sebastian resigned, but then was reappointed for 48 hours to build a coalition. The result here was that the French bond spreads hit 85 basis points over German bonds, the widest that they have been this year. And that political stress keeps the euro very sensitive, especially with growth already softening. Now, headed over to gold, we see that gold is pushing to new all-time highs. And so far, this metal has soared more than 50% this year. Last week, we were saying around the 40s. And this week, it's already rallied more than 50% year to date, making it the strongest annual performance since 1979. The shutdown, the dovish tilt from the Fed, the central bank demand, they've all created a perfect storm. And so now traders are treating gold as a new macro benchmark, using it as a proxy for policy credibility and inflation expectations. A lot of other metals like silver and platinum are also catching some of the same moves and following the same moves. But one thing to remember is that the higher we go, the more stretched sentiment becomes. And we expect short-term volatility, but the macro structure still remains bullish until Fed pivots back to a hawkish tone. Now let's take a look at Forex Factory here, or one other thing that I did want to mention, which you will see. And this is kind of a short-term move here, especially with the yen. But when we move on to the technical side, you will see that a lot of the pairs, especially GJ and UJ, which are the two that we break down in the weekly outlook, did gap up based off of this news right here. This person here is a House of Representative member in Japan, and the market started pricing in this news, especially at the market open after the weekend, so yesterday's Asian session and even today's Asian session, where this was investors wagering that this member of House of Representatives pro-stimulus stance would result in a slower timeline for the Bank of Japan's policy tightening. So potentially that playing into, are we really going to see those rate cuts, or are we going to see a rate cut from Bank of Japan this month and then again just holding out until the end of the year like the Fed? And if that does happen, if we do end up seeing those delayed hikes, then that is going to tempt the traders back into a strategy known as the carry trade. So we're going to continue the developments on this throughout the week, but I did want to flag this before we move on to the technical side. Now looking at the economic data, we started off quite easy. Same thing today, not much coming out. And then tomorrow we have some FOMC members who will be talking. So this is going to be very important, especially that gives us an outlook of what to expect going into end of the month Fed meeting. And then in Asian session, we have interest rates coming out from New Zealand. We have Bank of Japan's governor talking. So if you're trading, JPY, that is something that you want to be watching out for. Going into Wednesday, we have, again, more FOMC members who will be talking throughout the day. And then we have the FOMC meeting minutes. This is very short-term volatility in the markets, but sometimes you can catch some great moves when this red folder comes out. And then as we continue down into Thursday, unemployment claims, we didn't really get that last week. And so if we do end up seeing a government opening up, then we will definitely see last week's unemployment claims and this week's. That's why it's listed twice. But if the government shutdown continues, then we're not getting unemployment claims this week either. But Powell will be talking, and so expect some volatility around then too. This is a pre-recorded video at the Community Bank Conference hosted by the Federal Reserve Board. And then continue down into Asian session, you have the RBA governor from if you're trading the Aussie dollar. And then going into Friday, it is not NFP week, but this is delayed data. So once again, if the government does open up, then we are expecting that NFP data will come out. If the government does not open up and we roll into week 3, then again, we don't get NFP, but we will get consumer sentiment and inflation expectations because this is private data. Now let's go ahead and take a look at the technical side. Starting off with US 30. All right, we are on the weekly time frame, and we see that price this week so far has created a bit of a top wick and then pushed back down bearish. And that is that 47,000 mark, which we will adjust based on candle body closures on lower time frames. So that is the last week's top wick right there, and then we came pretty close to that level and then pull back down. This was around 46,900 level. So we're going to keep at 47,000, and then we'll adjust out the candle body closures on the daily, 4-hour, and the hourly time frame. We already have created a bottom wick rejection, and this is, we'll just call it 46,500 since that was last week's level as well, and we're pretty close to that. Now coming onto the daily time frame, I'm going to adjust that to the top wick rejection here and call it 46,900. So that's where we made a top wick on the last daily candle, push back down. This last daily candle did dip into kind of this overall resistance area, rejected that and came back and closed right here. We have a new daily candle that started forming with a bit of a top wick here. So that tells me that when this daily candle started forming, there was already a ton of bearish pressure to the downside. So we're looking for a retracement to come back down and first tap into 46,500. If price continues bearish from there, then the first target after that is going to be that 46 around, let's say 400, which is this resistance. And if price continues further down, then we're headed right back down into this previous support, which if I draw a zone here, we can tell that this is a very strong level where price keeps rejecting. We consolidate a little bit, but once we did break above it, we came back, retested that as a support, and then continued that rally to a new all-time high level. So again, first target right here at 46,500, and then after that 46,400. And then if price breaks even lower than that, then we're coming right back down into the support around 46,000. Come on to the 4-hour time frame. We had a quick little fake out, a retest of that level as a resistance, a clean retest, and then push back down, tap right into this level, give you another retest of this previous support. So a perfect break and retest setup with a ton of bearish volume to the downside. And then right here, again, holding on to resistance and then pushing back down. So what I want to see going into London session or even New York session or even tomorrow's Asian session is if price can hold on to this 46,500 as support. And if not, can we look for that continued rally up back into 46,900? For either direction, we don't need a ton of headline or we don't need a ton of economic data. This is purely based off of technical moves, based off of higher time frames, where we've had that massive rally. And the market is really going to correct that rally in two ways, either consolidation or retracement. So either we wait for a further retracement, which would look like a break below 46,500 to head right back down into that 46,000 mark, because when we come onto the daily time frame or even the weekly time frame, it's been a massive rally up really since this level down here below the 45,400 mark. So somewhere around here, which was a retest of this broken high right here, and then a continuation up. And after that, we've just had a pretty good rally to the upside. And so we do need to see some sort of a retracement of that or a price coming back down into this multi-day consolidation level, grab some liquidity, and then continue to the upside. We can see that upside if the government does open up and we start to see more of that optimism kicking in, or even if, you know, the Hamas deal comes along and then we start to see a breakthrough in that too. Drop down to the 1 hour. Right now, we're just kind of just sitting in consolidation. So once again, either we hold on to this area as support and then push back up, or we break right through it and then we look for cleaner sell opportunities to come back down into this zone here. onto GBP USD, we are sitting in this multi-week consolidation right around here. And I will narrow in this zone as well. So this is really the support, 1.34. And that is that multi-week consolidation. I'm going to narrow that in a bit more to sit right on top of the previous weekly top wick candle, because it seems like we are starting to push back up bullish here a bit. So if we can continue back up bullish, we're headed right into that 1.353 level. Let's drop down to the daily time frame. And based off the daily time frame, it seems like we are sitting in this bit of a consolidation here. So I'm going to mark off right around here. The previous daily candle did close just a little bit above that, but it seems like the current daily candle is kind of rejecting this level. So as long as we're above 1.348, then we can continue back up bullish into 1.353. Pretty good buy opportunity, a zone to zone trade. But if price breaks below this, then we're headed right back down into this bit of a support level right here. And that is where that gap down happened. So this is where the previous daily candle closed on Friday. And then this is on Sunday for me, being on the west side, or Monday morning for you guys on the East Coast, or not the East Coast, but the Eastern countries. That's where you have that push up. So that was a gap down. The market filled that in the previous daily candle. And then here we are looking at the current daily candle. So simply, if that's going to be a bottom wick and then flip back up bullish, if that happens, then we have a pretty good opportunity for about 40 pips or so. This is a major pair, so it is definitely going to move a lot slower compared to the other pairs that we look at, US 30 gold or any of the minor pairs. Coming up to the 4-hour time frame, it seems like we pretty much just took a day to fill in that gap, and then after that kind of sit around this resistance area. So if price breaks below that, we're looking for a break below the current 4-hour low and a continuation back right down into this zone. And so this is going to be a zone to zone trade opportunity, either for sells or zone to zone for buys. EU seems to follow, for the most part, the same exact structure. So same thing here, we are in that multi-week consolidation level. And then we have bottom wick that's already been formed on the current weekly candle. Let's drop down to the daily. So daily, we've had a push down, a retest into this area, and then we've had the previous daily candle break back down into that 1.166 area, reject that, and come back and close right into this level. So as long as with the current daily candle, we can see that price holds onto this area as resistance, we can look for a wick fill trade to come back down into that support. Same thing, we're looking at a zone to zone opportunity. Here we've had a nice bearish structure, consolidation, break below that. It seems like a retest. So same thing, if we can break the low and continue pushing. If I were to really narrow in my zone, this would be the area that I would wait for price to close below, just so I don't get stuck in that consolidation, and then look for quick sell opportunities, quick scalps into that 1.166 area. If price rejects this and we end up holding onto a support here and then a push back up, then we have those clean buy opportunities to come back into this consolidation resistance up top here. But one key thing to understand here is that a lot of the sentiment when it comes to the euro is that everyone, or traders for the most part, are shorting the euro because of the fading risk, French risk premium and the fundamentals that we just went over, right? So the euro is right now quite weak compared to a lot of the other major currencies. And we see that from a technical perspective. We're seeing the bearish structure here too. And here is that gap up that I was mentioning, especially with the last yen article that we took a look at. So the market has yet to come back and fill in that gap. So this is where the previous weekly candle closed, and here's the new one. So I'm going to mark off the current candle body open. And then we have created a bit of a top wick here, which is 203.1. Drop down to the daily. So the previous daily candle closed bullish here with a lot of, not so much of a strength from the pound, but the weakness from the yen. And then we have the current daily candle, which already made a bit of a top wick. So if we're going to look for some sell opportunities, I want the current daily low to be broken and then continue to push back down. If that happens, then we're confirmed coming back down into 200.8 and then potentially looking for a gap fill right here. So these are quick easy trade opportunities. Whenever there's a gap in the beginning of the week, we're always going to see that gap being filled later on into the week. So these are easy trades to catch. For any buying opportunities, we're waiting for price to break above that 200.1 level and then continue back into these previous highs. So I'm not really worried about this right here. That can be a quick scalp opportunity to the upside. You're simply looking at about 125 pips or so. So like quick scalp or even day trade opportunity. But if that bullish momentum continues for the pound because of the yen weakness, then we're targeting this area up top here for those continued buy opportunities. Drop down to the 4-hour time frame. We had that gap up. The price tried to correct some of that movement here, but then going into London session and then even into New York, we continued on that bullish momentum to the upside. So we just need this 4-hour here to be broken and then continuation back down for those sells to come back and tap into this 201.3 level and then a continuation further back down to fill in that gap. And then again, for buys, break and retest support formation and then a continuation back up. You look to the left for that, and this is really the area that we're targeting for those continued buy opportunities to come back into this bit of a consolidation here. And something similar happening on UJ as well, same thing. Last week we closed down here, and then this week we opened up, so we still have to come in and fill in that gap. So we've got a top wick formation here already at 150.650. And then this weekly's candle body open, I'm just going to do it just above that, right at that resistance here at 149.5, drop down to the daily. And then same thing here, the current daily candle is making a bit of a top wick. So if price can break its own low and then continue back down bearish, then I'm looking for those sell opportunities to the downside. One cool thing to notice about this candle here is that this is where the previous daily candle closed, and then we've already had a bit of a gap down here with the new daily candle opening up right here. So this is where the previous daily closed, and this is where the new daily opened up. We push back up, and then it seems like we're rejecting it. So if we are simply rejecting that, and then we're looking for sell opportunities to come back down into 149.5 and then fill in this gap. Once again, very quick, quick trade opportunity, very easy trade opportunity here to come back and fill in the gaps. If price continues to break the high, then we're headed right back into this next area of support right here. That price seems to be respecting here to the left. And then whenever it did break through, it did have a ton of bearish volume to the downside. So either way, we do have great trading opportunities. If you're looking for sells, you start off for about 75 pips or so. And then if you're looking for that gap fill, that's almost 275 pip move. And then if you're looking for buying opportunities, you wait for the high to be broken and then continue to the upside for about another 80 to 90 to almost 100 pips, depending on your entry. Now we come over to gold, onto the weekly time frame. Pretty close to that 4,000 mark. 3981.1, and then mark off the candle body open because we don't have any bottom wick here. And if you notice, for the last couple of, like almost over a few months, on the weekly candle, barely any bottom wick. That's that massive bullish momentum on gold. And that shows you, that's the proof of the safe haven demand that's following, given the uncertainty on that geopolitical level. When we come onto the daily time frame, again, a bit of a top wick. So what we want to see is quick low retracements like this, even though we have been in that massive bullish momentum based off the weekly time frame. But remember, on the fundamental side, I was talking about the more stretched we are, the more stretched the sentiment is going to be. So at some point, we do want to see some of those healthy retracements. We do want to see a bit of consolidation and then a continued rally up. So here, same thing for any sell opportunities. You want the daily low here to be broken, and then you're looking for quick sell opportunities. The only way you're really going to get that in the current environment is that if we see any development and positive development on a potential deal when it comes to the US, Israel, and Hamas, any potential optimism around the government opening up, anything like that. Right now, we're sitting in a perfect storm for gold to continue to rally up. In that case, because we keep tapping into new all-time high levels, you're really targeting a one-to-one trade. And then as your trade gets close to your TP level at that one-to-one, you increase it by another one-to-one. And then from there, that's a safer risk management approach. to the upside. So then you're not just trying to be optimistic and trying to catch trade opportunities, but really you do have the data and you do have the price action supporting a move like that and the sentiment there. When we drop down to the 4-hour time frame, we see a bit of a consolidation and then a push back up, a bit of a break and retest setup, and then after that, the volume just slows down here. So same thing going into either London session or New York session. Either you wait for a support formation here on lower time frames, like the 1 hour, 30-minute, 15-minute, depending on if you're trading around high volume time, and then look for your trade opportunity to the upside. Or if you see retracements and you're waiting for the lows to be broken and then continue back down, the first target really being closer to the support area here. And then after that, looking for another 1-to-1 coming back into the support closer to 3,900 mark. Overall here, gold will still remain a core long, but again, smart money is now scaling out into strength and reloading on these dips. And so that's exactly what we're going to look for as well on the intraday time frame. So we're going to wait for those retracements. Like I said, it's been a massive rally up on the weekly time frame. We see that from a price action perspective. And so when we drop down to lower time frames, we need those consolidations. We need those retracements in order to continue buying these dips to the upside. So overall, as a quick recap, what I'm watching this week is the timeline for U.S. Shutdown resolution, France's budget deadline and bond spreads, BOJ commentary ahead of their next meeting, any developments on that carry trade that we went over the last article, the Gaza hostage checkpoint, and the tariff timeline for heavy trucks starting November 1st from the U.S. So that's the map. In a week of no official data, the price action is going to be your best friend. So trade the reaction, not the prediction. And if this outlook helped you structure your week, drop a like and share it with your trading group and comment where you're watching. Trade well, manage your risk, and I'll see you guys in the next one.